Welcome to the CFA Level 1 presentation on technical analysis. Technical analysis is a study of collective market sentiments. Values and thus prices are determined by supply and demand. Supply and demand are driven by both rational and irrational behavior. Efficient market hypothesis does not hold. Technical analysis can be contrasted with fundamental analysis. So the key point here is actually contained in these two statements. With most of what the CFA is about is fundamental analysis, where you determine whether a stock price, say a stock is priced at $20, you figure out whether this is a good price or not based on fundamental analysis, where you look at earnings per share data, cash flow data, you project it into the future, you do a lot of analysis, and then you determine whether the price is valid or not. So this is fundamental analysis. This analysis does not take into account any psychological aspects or behavioral aspects of investors. Technical analysis, on the other hand, does consider possible irrational behavior, where if there is extra exuberance about a stock, the stock price might go up, and technical analysis does take that into account. Also, efficient market hypothesis does not hold according to technical analysis. We will see this in a lot more detail when we cover the topic on equity, but the quick summary is that efficient market hypothesis essentially states that all securities are fairly priced given the existing information, about the stock markets or actually any information. Whereas technical analysis basically says that there are several other factors, including irrational factors, psychological factors, etc., which also impact the price of a stock. What are the advantages of technical analysis? The obvious advantages are given on this slide. Price and volume data are observable. To understand this point, let's contrast this with fundamental analysis. So in fundamental analysis, you come up with the price using, say, future cash flows, future earnings, etc., which are just expectations and estimates. So based on those expectations and estimates, we come up with a stock price or a fair stock price, and those future values are not observable. Technical analysis uses current and past price and volume data, which clearly is observable. Technical analysis can be applied to non-cash flow assets such as commodities, gold, copper, etc. So it's very hard to apply cash flow oriented fundamental analysis to non-cash flow assets. In fact, it's impossible. But with technical analysis, we can apply rules of supply and demand, market sentiment to come up with the price of non-cash flow assets. This technical analysis is useful when the financial statement data is dubious. So fundamental analysis clearly relies on your income statement, balance sheet, cash flow statement, etc. But if the information in these statements is not reliable, then obviously fundamental analysis is not useful. Technical analysis, on the other hand, does not rely on financial statements and therefore works well even if the financial statement data is not reliable. It incorporates psychological as well as economic reasons behind price changes. So if, for example, market sentiment is positive, and especially positive for a given stock, that psychological piece of information is also incorporated when you do technical analysis. Just note that if the price and volume data do not reflect supply and demand, then technical analysis does not work very well. Now let's look at some basic charts that are used in technical analysis. The simplest kind of chart is a line chart, where we basically have time or trading days on the x-axis and the price on the y-axis. So you might have your trading starting from 1 August, and on 1 August, let's say the price was 50. So you will have a price chart that sort of might go something like that. So all that is saying is on different days, what is the average price of the stock. With bar charts, rather than looking at average prices, we look at the highs and lows for each trading period. So here again the y-axis will be price. So y-axis is price. X-axis now would be trading period. So this would be the first week of August, second week of August, say third week of August, or it might be months, etc. So this is still a time dimension. And then for each trading period, we have a simple bar that shows us the low for the day, the high for the day, and so on. So this is a bar chart. Candlestick charts are extremely popular in technical analysis. They are like bar charts, but use boxes. So let's understand this candlestick chart. The y-axis again is price, stock price. The x-axis is a time dimension, where each item here might be either a day or a week, some unit of time. And this is a slightly more elaborate form of a bar chart. So let's see what these things mean. Take this item over here. So for each time period, we will see something like this. So you will see something like, and this sort of looks like a candlestick. So what does this mean? If you have a bar that is clear, this means that for that time period, let's say that we are talking about a day, if it's clear, that means the closing stock price was greater than the opening stock price. So if it's clear, that means this was your closing. So this was your closing stock price, this was your opening stock price, and these wicks at either end, this represents the low for the day, and this represents the high for the day. When you have something like this, which is filled, so then you have this which is filled up. In this case, this is saying that the stock went down during the day. So this was the open, and the close price. Remember, the vertical axis is price. So filled up means that the closing was lower than the opening, so the stock is going down on that day. And here again, this represents the high for the day, and this represents the low for the day. So in this picture, what you can see is, during this time period, the stock is generally moving upwards. So we constantly have higher closing prices, so the stock is moving upwards. So it's normal to see a bunch of clears together if the stock is moving up. And then in this time period, the stock price is moving down. So notice that the close in all these cases is below the opening. So this shows a few days where the stock was heading downwards. Point and figure charts have been used for a very long time, and these are slightly different from the sorts of charts we've just looked at. The major difference is that the x-axis represents the number of changes in direction as opposed to some form of time. So important to realize that with point and figure charts, the x-axis is not time. The y-axis, however, is still some form of stock price. but there are a few important points. So each one of these you can think of as a box. So in a box we will either put X, as you see here, or these boxes might have a 0 or an oval, as you see in this column. Now what's a box size? You need to define box size. Let's say that the box size is ₹1. So you need to define a box size. In our example, we'll say the box size is ₹1, and a reversal size, let's say that the reversal size is ₹3. And let's say that we are looking at the stock of FFC. On the y-axis, the box we said is ₹1, but each one, the y-axis represents a price. So let's say that at this stage the price is 100. So if the box size is 1, here the price would be 101, then 102, etc. What this point and figure chart tells us is that as long as our price is moving up or staying in roughly the same range between 101 and this is 102, then 103, 104, 105. So as long as stock price is in the 100 to 105 range, we will remain in this first column. Only when we have a reversal of 3, so if for example from 105 or even say 104, the stock price comes down by 3 rupees or more, that's when we create a new column. So once the stock price comes down by 3 rupees or more, then we have this column where we are ranging from 104 to 101, and we will stay in this column until there is another reversal where the stock price goes up by 3 rupees or more. So based on that you can now understand this trend. So again, this highlights the point that each column, and hence the x-axis, represents the number of changes in direction rather than a time dimension. Relative strength analysis. In relative strength analysis, we basically determine the asset price, divide by the benchmark, and draw a line. Uptrend means increasing relative strength, and downtrend means so uptrend means increasing relative strength, and obviously a downtrend would mean a decreasing relative strength. So let's look at FFC as our stock or our asset, and the Karachi Stock Exchange KSE 100 index as a benchmark. So what will happen in this situation, what you can look at as over the last let's say 10 months, or let's look at all of last year. So from month 1 through month 12, what we can look at is we can see how we can look at FFC stock prices versus we can look at the KSE 100, and then we will also look at the relative ratio, so FFC divided by the KSE 100. So this ratio is what we plot, and over time here we have the ratio, which is this ratio on the y-axis. So if this ratio is going upwards, that is implying that FFC is becoming stronger relative to the index. So the relative strength is positive. On the other hand, if the graph had been going downwards, that would imply that FFC is becoming weaker relative to the index, and the relative strength would then be weak. Trend analysis. An uptrend means that a stock is reaching higher highs and retracing to higher lows. So let's look at an example. This would again, we would plot the price against a time dimension, And if you have a stock that's going up and then this coming down means retracing and then going up again and then coming down. So if you have a stock that's operating like this, notice that it is reaching new highs and then retracing to lows, but every time it retraces to a higher low. How do we draw a trend line for this? The way the trend line is drawn for an uptrend is we connect the lows. So here this would be the trend line and this is a uptrend. Trend line for a downtrend touches the high. So what's a downtrend? So in a downtrend we are going something like this. So the highs are constantly moving downwards. So when you do a downtrend, you connect the highs. What is a breakout from a downtrend? So let's again draw that simple downtrend. So if you have a stock that is trending downwards, and then let's say a breakout means that the downtrend stops and then the stock starts moving upwards. So at this point basically, so we had a downtrend and then roughly at this point we broke out of the downtrend and then we started moving upwards. So at this point we broke out of the downtrend. When we have an uptrend and the uptrend stops, then that's called a breakdown. So let's draw this very fast. So here is your uptrend reaching higher highs and retracing to higher lows. Then if we have a downward movement, so at this point we broke down. So this was the uptrend and here we break down. So this is at this point we break down from a uptrend. Support, resistance and change in polarity. So just let's just again understand these concepts through a picture. So if you have a stock that again price on the Y and some time dimension on the X, if you have a stock that is doing something like this, then what we say that the support price is the low price range in which buying activity stops, decline in price. So this would be our support level. What this is saying is that this is a low price range, let's say it's $10, where when a stock hits approximately this price, there is lots of buying activity because people think that at $10 this stock is cheap. So buying activity, and that stops the downtrend and causes the stock to go up. So this line is called the support line. Resistance is a high price range in which selling activity stops an increase in price. So this is your resistance line, where we are saying that let's say the resistance line is 13. At 13 there is this psychological limit where traders think that now the stock is expensive. So here there is sell activity which causes the price to go down. So remember, this ties in with supply and demand. So here there is selling, which means lots of supply, and hence price goes down. So resistance level, support level. Change in polarity is where the old resistance level becomes a new support level. So now what this means is, let's say that the stock goes up and now for some reason we go past this old resistance line and we have a situation like this. So in this case then the old resistance line, which is over here, becomes the new support line, and we have a new resistance line that is somewhere up here. So when something like this happens, this is called a change in polarity. A reversal trend is when a trend approaches a range of prices but fails to continue beyond that range. So the general idea here is that you have, say, an uptrend, you hit some sort of a pattern, and then you start coming down. So this is called a reversal. So from an uptrend to a downtrend, we have a reversal. First thing is that you need to understand that there are several different patterns, several different reversal patterns, and the ones that you should know, or at least the names that you should know, are head and shoulder pattern, double bottom, double top, triple top. So these are names of patterns. I think that from a CFA perspective, the one that you should just get into a little bit of detail on is the head and shoulder pattern. So how does this work? So you have, again, let's look at price versus time. So in a head and shoulder pattern, which is the reversal pattern, the stock goes up, and there is a concept of a neckline, head and shoulders. So what we are doing here is, so let us say this is our neckline, and we create we have a small shoulder like this, and then a head, and then a shoulder, and then going back down. So this is called the neckline, this is the shoulder, and this is the head. So when we see something like this, this is called a head and shoulder pattern. And let's say that the neckline is at 10, the shoulder is at 12, and the head is at 15. Then the price target, this is a reversal pattern, which means that the stock price will go down. So the price target would be the neckline, which is 10, minus the head minus shoulder. So head is 15 minus shoulder is 12. So 10 minus 3 is equal to 7. So we are saying that the new target is $7. An inverse head and shoulder would be basically a inverse version of this picture. So with the inverse head or shoulder, that reversal trend would be from going down to going up. So the concept, you can just think of a upside down person where the head would be the lowest, and then you have neckline and shoulder, which is basically a mirror image of what you see here, a mirror image in the x-axis. A few nice problems in the curriculum on this, which I would strongly encourage you to do. So what we just talked about was a reversal pattern. Now let's look at some continuation patterns, which implies that stocks will continue in the same direction. So a continuation pattern is basically a pause in a trend rather than a reversal. Examples are triangles, where prices reach lower highs and higher lows. So what's an example of a triangle? So you might have a stock price that's operating like this. So notice that the highs are lower and the lows are higher. So this is called a triangle pattern. Rectangle patterns are also examples of continuation patterns. So what's a bullish rectangle? Where you have an uptrend, and then for some time the stock price basically forms a sort of a rectangle, and then the uptrend continues. So this is a bullish rectangle because the stock price is going up. What is a bearish rectangle? Price time, so stock price coming down, and then temporarily we make this rectangle and then keeps going further down. So this is an example of a bearish rectangle. When you hear terms like flags and pennants, looks a little bit like a flag. The triangles look like pennants. When you have so flags and pennants simply refer to rectangles from this slide and triangles from the previous slide when they appear on short-term price charts. So basically, if you are looking at the daily charts or daily prices in a given week, and if you see a pattern such as a triangle or a rectangle, then they are referred to as flags and pennants. Technical analysis indicators. We have price-based indicators such as moving average lines, Bollinger Bands, and we have oscillators, which are indicators based on market prices. They oscillate around a given value or between two values. Let's talk about price-based indicators in a little more detail. One type is a daily price chart with 60-day and 20-day moving average, or you might also have 30-day and other number of days in your moving average. What does that mean? Basically, you might have a price time stock graph which is for very volatile. To smooth this out a little, you can actually look at, say, a 20-day moving average. So what the 20-day moving average will do is so let's say that this is your 20-day moving average line. So 20-day moving average. What this 20-day moving average line is doing, any point in time, this value is the average of the prices over the last 20 days. So notice that the 20-day moving average will be smoother than the stock price. And if you want to make this even more smooth, then you can take a 60-day moving average and so on. Bollinger Bands. So here's a colorful picture that I took from John Bollinger's website, who's the inventor of Bollinger Bands, and he talks about this in his book Bollinger on Bollinger. In any case, the idea here is this. So here we are looking at his version of a candlestick. So again, the y-axis is price, x-axis is time, and these colorful bars represent the stock prices during each trading period. Let's say each trading period is a day. A middle band would be, let's say, a 20-day moving average. So this line that I am making red is our middle band, which is the 20-day moving average. Obviously we can make it a 30-day moving average or whatever, but default typically is 20-day moving average. And then we draw an upper band, which would be the 20-day moving average plus 2 standard deviations. So depending on the how much variation there is in the stock prices, so we find the standard deviation of returns or the stock price, and we create an upper band that is 2 standard deviations above and a lower band that is 2 standard deviations below. Again, this 2 standard deviations is the typical default. You can set this up to 3 or 4 or 1, how many ever standard deviations you want. But the point here is this: when you create an upper band and a lower band, you can then see whether the stock price is at the lower end or at a higher end. What is suggested here is, if the stock price starts hitting the lower band, then there is a chance that the stock prices will start moving up, and if the stock price starts hitting the upper band, then the likelihood is that stock prices will start moving down. So a contrarian strategy then basically is to buy when others sell and vice versa. So the contrarian aspect here is people are selling over here, which is why the price is down, and the contrarian strategy is to actually buy over here because you are expecting the stock price to go up. Oscillators are a little bit complicated. I think my suggestion is, at the very least, just understand the basic points on this slide, and then if you have time you can go read this in more detail from your study notes or from the curriculum. So as mentioned earlier, oscillators are indicators based on market prices. They oscillate around a given value or between two values. We have convergence oscillators which show the same pattern as prices and suggest that price trend will continue. Divergence, this is where the oscillator shows a different pattern from price and implies a change in price trend. There are many types of oscillators, and at the very least just know these names: ROC, this is the relative strength indicator; MACD, stochastic indicators, which has to do with probability. So just learn these names, and then if you have time, go and read up about them from your notes or from the curriculum. Non-price based indicators, this is important. These tell us about what sort of investor sentiment exists in the market, and the typical non-price based indicators are the put-call ratio. What's the put-call ratio? If you will understand this in more understand this better when you do derivatives, but put is where people are making money based on stock prices going down. So if the put-call ratio is high, so if this is put-call ratio is high, this is a bearish signal. That means investors are expecting the stock price to go down. VIX talks about the volatility of options on the S&P 500. High volatility of options suggests that investors fear a decline. Hence, this is a bearish signal. For those who don't know, bearish sign means that people expect stocks to go down. Bullish means that investors expect stock prices to go up. Margin debt, this is the amount of debt that investors have taken to buy stocks. If the margin debt is high, that means people have taken a lot of debt to buy stocks. They expect stocks to go up, so this is a bullish sign. Short interest ratio, this is a short refers to where investors have borrowed money to buy stocks. So high short interest ratio means lots of people have borrowed stocks and sold them. This means that investors expect a short-term decline. So investors are expecting the stock prices to go down. But these stocks have to be repurchased later. So opinion is mixed as to whether this is a bullish sign or a bearish sign. You'll understand these terms better when we cover the equity topic later in this course. Non-price based indicators. So you have, continuing, mutual fund cash position. This refers to mutual funds, the amount of cash held by mutual funds divided by total assets, typically stocks, bonds, etc. If the amount of cash is high, this is a bearish signal because it indicates that mutual fund managers do not expect stock prices to go up, and hence they have put a lot of money in cash. So this is a bearish signal. New equity issuance would be a bullish sign. And then there is this interesting indicator called TRIN, which stands for short-term trading index. It's also called the ARMS index, which is basically the number of advancing issues divided by number of declining issues. The whole thing divided by volume of advancing issues divided by volume of declining issues. And you can do the basic maths here. If this ratio is greater than 1, then that indicates that the majority of the volume is in declining shares, which is a bearish sign. And if this ratio is less than 1, then the majority of the volume is in advancing shares, which is a bullish sign. And you can pause the video here, study this formula, and make sure that this point over here makes sense. Finally, cycles and waves. Technical analysts believe that financial markets move in cycles. So just like the economy, they believe that stock market also moves in cycles. The Elliott wave theory, this basically states that financial market prices can be described by an interconnected set of cycles. And intermarket analysis, Basically, this says that there is an interrelationship among market values of major asset classes. So that is it for now. I have gone through this very fast. My view is that even though most of this material actually is very new this time, so strongly encourage you to do all the questions from the curriculum, and based on the material covered in these slides, you should be able to answer almost all the questions. If you have time, then you can go study this material in a lot more detail from your study notes or from the curriculum.